If you missed the financial news recently, let me summarize everything that has happened in the last few weeks to find out if the market will keep crashing or it will finally recover. Back at the end of the February, when it seems like the market won't crash further, it keeps falling. And right now, everyone is confused about whether they should buy or wait till it keeps dipping more. Personally, I would love for it to keep falling, but it seems like it won't be because the Fed got out in the 17th of the March and clarifies everything. We will think about what the Fed says, what does it mean, and how it is going to impact the stock market. One of the metrics investors use to value companies is discounted cash flow. It can help us to understand where the market is overall headed to without getting into a lot of details. I will explain what discounted cash flow is. How is that related to what the Federal Reserve said? And will there be another crash? Interest rates aren't just important because they have make borrowing money cheap or expensive today, but also because they influenced the value of future cash flow, which is what investors are concerned about the most. You don't care about how much the company is earning today or how much it has been earning in the past. That matters at the end of the day is how much the company is going to earn in the future. Based on that, you decide whether you should invest in this or company in this or company or not. Stocks always complete with other type of the investments such as the bonds, cash, fixed deposits, whatever. Let's say you have $1,000 in your pockets. It's better to invest in the stocks market, bond market, or just keep it in your wallet. Obviously, investing is way better. Say interest rates are 5%, so if you invest it in the government bonds, your $1,000 will worth $1,005 in the next year. So it's important to look at the time value of the money. The sooner you have the cash on your hands, that more it worth because the sooner you will invest it, a dollar today is worth more than the dollar tomorrow. So if the company is going to earn the $1 billion 5 years from now, it's not going to be billions because $1 billion 5 years from now not worth less than $1 billion worth today, because you could invest it and get 5% at least. So it's not enough to look at the company such as a cash flow. Or this is how much the company is going to earn in the next 3, 5, or 10 years. But you have to find the present value of that future cash flow. How much that $1 billion 5 years from now worth today. It sounds a bit complicated, but I will try to my best to simplify everything. You can use this metric in the future or to value other companies. Of course, no one knows how much any company would earn in the future. It's all predictions, but these periodics are based on the multiple factors such as how the company is performing today, where is it investing, what in their strategy, how is the business environment, what are the chances that the company will hit its annual objectives, what is the political climate. There are a lot of the analysis who paper a certain type of predictions. Let's say hypothetically there is a company called Amazon and it's expected that it will generate $100,000 every year from the next 3 years. On the other side, interest rates are 5% and they are expected to stay there for the next 3 years. At the rate of $100,000, the next would worth $95,000. I got the number by dividing the future cash flow, which is $1,100, by the 1 plus 0.05. One because the formula is CF 1 plus R year. If we apply the same formula in the second and the third, these numbers we are going. First year $95,000, year 2 $90,000, year 3 $86,000. The company's future cash flow isn't $300,000 as it seems at the first glance, but $272,000 or the sum of these three numbers. I told you it's not complicated as it seems. There is when the interesting part starts. What happens if the interest rates are lower? What happens if the Fed lowers interest rates to 1%? How will that impact the project futures cash flow? Let's do the math. First year, instead of the $95,000, is going to 99. When the Fed lowers interest rates suddenly on paper, these companies are going to make more money even though nothing absolutely changed for them. Let's do the second year and the third. The second year will be 98 and total sum of the $294,000, which is higher than the previous 272. Remember, the most important thing that investors care about is how much the company is going to earn in the future. That's why whenever the Fed lowers interest rate, stocks becomes much more attractive, even if they are not going to borrow money. This metric is even more important when it comes to the tech stocks because most tech companies are betting on market huge profits in the future, such as Tesla. It's great company, but it's very profitable. But the idea behind it is that in future it's going to be super profitable, it's going to make a lot of money, but dollar today worth more than tomorrow. So when the Fed lowers interest rates, tech stocks jump through the roof. So since the end of the February, when the stock market starts falling, everyone thought that it's just one day thing. Honestly, I jumped into bought some shares. I wasn't expecting that it could get worse. I mean, theoretically it could, but if it doesn't, I will miss the opportunity, but the market keeps falling and falling. Of course, I bought more stocks, and on the 17th of March, the Federal Reserve said, listen guys, we understand that the economy hasn't recovered yet. Some businesses, of course, are going to better than they did last year, but we feel like in the next few years we'll keep interest rates low. What do you think low means? 0.25% at best. You can get lower than that unless you go negative, which already happened in some countries. Anyways, it's a clear message from the Fed that this year we will keep the rates low, which means the market will most probably keep rising. Of course, that's going to cause inflation, but the Fed says we know that, but that's not a problem now. Imagine what message does this send to investors: don't hold cash because it's going to be worth a lot less. This means there will be more money through into the stocks market, which means stocks will keep rising. So based on current circumstances, it's difficult to believe that there is going to be some kind of the major cash in the coming future at last till the end of the year. Another corrections? Maybe. I don't know, but a correction happens from time to time, so I wouldn't be surprised to see a few of them throughout the year. Especially if you are the dollar cost averaging, these dips are the perfect time to buy. If the market is hitting higher and higher, buying when there's the dip is the perfect options, by the way. I'm not a financial advisor, and everything I said in this video is for educational on the entertainment purpose and nothing more, so I don't because for your financial decisions on what random people say on YouTube. Low interest rates also means that money when interest rates are at that almost 0%, any money you borrow is free. Even if you don't need that money, you will still turn a profit if you borrow it and invest elsewhere. It makes sense to borrow as much as possible at 0.25%, for example. So any return you make above 0.25% is considered to be profit. So when the Fed is planning to keep the rates at such a low rate until 2023, it's extremely difficult to imagine whether there could be a crash or anything like that. Of course, we don't know for sure where interest rates will stay that low for another 2 years. Anything could change, but only time will tell. What really worries me is higher bond rates. Bonds have inverse relationships with the market because bonds are much safer than the stocks market. With stocks, the company could go bankrupt or perform really poorly, but with government bonds, the change that the government will collapse are really low. So whatever bonds rates rise, a law of investors' choose bonds over the stocks. So the stocks market shows down, but we will talk about that in another video. For now, I really want to know your opinion about this new form. Regular videos on the channel aren't going to stop, but we want to try something new where I can update you about the financial news, about what's happening in the market, and try to help you to read between the lines. But to be able to make videos a bit quicker, we have to make them simpler. So I am curious to know your opinion. Let me know in the giving this video the thumbs ups and comment below. Thanks for watching, and until next time.